Today, we will talk about the Dow Theory, a financial theory that predicts market trends. It was developed by Charles H. Dow and operates on the efficient market hypothesis. The Dow theory is a financial theory that states that the market is in an upward trend if one of its averages advances above a previous important high, accompanied or followed by a similar advance in another average. For example, if the Dow Jones Industrial Average climbs to an intermediate high, an investor might watch the Dow Jones Transportation Average climb to confirm an upward trend. The Dow theory is an approach to trading developed by Charles H. Dow, who founded Dow Jones and Company Incorporated and developed the Dow Jones Industrial Average in 1896. Dow believed that the stock market as a whole was a reliable measure of overall business conditions within the economy and that by analyzing the overall market, one could accurately gauge those conditions and identify the direction of significant market trends and the likely direction individual stocks would take. The Dow theory operates on the efficient market hypothesis, which states that asset prices incorporate all available information. Earnings potential, competitive advantage, management competence, all these factors and more are priced into the market, even if not everyone knows all or any of these details. In more strict readings of this theory, even future events are discounted in the form of risk. Markets experience primary trends which can last a year or more, such as a bull or bear market. Within the broader trends, secondary trends make smaller movements, such as a pullback within a bull market or a rally within a bear market. These secondary trends can last a few weeks to a few months. Finally, minor trends can last a few days to a few weeks. These small fluctuations are considered market noise. According to the Dow theory, the primary bull and bear trends pass through three phases. A bull market's phases are the accumulation phase, public participation, and excess phase. A bear market's phases are the distribution phase, panic phase, and exhaustion phase. For a trend to be established, Dow postulated indices or market averages must confirm each other. This means that the signals that occur on one index must match or correspond with the signals on the other. If one index, such as the Dow Jones Industrial Average, shows a new primary uptrend, but another remains in a primary downward trend, traders should not assume that a new trend has begun. Trading volume generally increases if the price moves in the direction of the primary trend and decreases if it moves against it. Low volume signals a weakness in the trend. For example, in a bull market, buying volume should increase as the price rises and falls during secondary pullbacks, because traders still believe in the primary bullish trend. If selling volume picks up during a pullback, it could be a sign that more market participants are turning bearish. Reversals in primary trends can be confused with secondary trends. The Dow theory advocates caution, insisting that a possible reversal be confirmed by comparing indexes. The theory contends that a trend remains in effect until there is a clear sign that the trend has reversed. Charles Dow relied solely on closing prices and was not concerned about the intraday movements of the index. Dow theory also includes the idea of line ranges, periods of sideways price movements. Traders should wait for the price movement to break the trend line before coming to a conclusion on which way the market is headed. One of the main techniques used to identify trend reversals in Dow theory is peak and trough analysis. An upward trend is a series of successively higher peaks and troughs, while a downward trend is a series of successively lower peaks and troughs. A trend remains in effect until there is a clear sign that the trend has reversed. A reversal in the primary trend is signaled and the market cannot create successive peaks and troughs in the direction of the primary trend. During an uptrend, a reversal occurs when the index consecutively fails to reach higher highs and higher lows over a long period. Similarly, the reversal of a downward primary trend occurs when the market no longer falls to lower lows and highs. Here are three key takeaways. 1. The Dow Theory is a technical framework that predicts the market is in an upward trend if one of its averages advances above a previous important high, accompanied or followed by a similar advance in another corresponding average. 2. The theory is predicated on the notion that the market discounts everything, consistent with the efficient market hypothesis. 3. In such a paradigm, different market indices must confirm each other in terms of price action and volume patterns until trends reverse. Hope this would help. Thanks for watching.